you work at a restructuring shop now. I mean, what kind of calls are you getting? Is there a reality here that will start to bake in anytime soon on the restructuring front?
Yeah, there's definitely a pickup in activity on the restructuring front, which is what you would expect with, a 450 basis point increase in rates over the course of a year. So, there was plentiful credit after the pandemic, given what the Fed and the Treasury and the Congress, frankly, did, right? The most stimulative fiscal package, in U.S. history, other than in wartime. Running a deficit of 15% of GDP in 2020, and the Fed obviously lowering rates and providing enormous liquidity to the market. So you had record volumes of high-yield leveraged loan issuance in 2020 and 2021 again. But obviously with the rate increases, that market has slowed down. And, companies that have maturities that they need to refinance are going to find it, harder to do it. Not necessarily because of the lack of availability, just because of the cost.
Yeah, we were speaking earlier with Al Rabel about the private credit markets and how rates have gone up there. So where do we start seeing the domino effect? It sounds like you're anticipating a lot of delinquencies, maybe defaults, bankruptcies even.
Well, first of all, I think the restructuring market has gotten a lot more sophisticated, actually, and so I think you won't see, there's a slight tick up in default rates, and you'll probably see that increase slightly, but there's an awful lot of out-of-court restructuring work going on, trying to avoid the very time-consuming, expensive Chapter 11 process. So there's exchange offers, liability management transactions of all sorts going on all over. And there's a lot of capital being willing to go to work to facilitate those transactions.
So I'm going to use your words that one of the greatest vulnerabilities to the stability of our financial system is actually the instability of our political system. And if you think about this impact of higher rates, there's two things. There's higher interest rates that we're going to face as a country, as well as a potential hit to GDP given inflation peaking here. So, I don't think that we've even hit the, nail on the head yet when it comes to this debt conversation. What is the big worry here at the end of the day? Is it the debt ceiling, or is it the actual debt load that the U.S. is carrying in and of itself?
Well, the Fed's really caught between a rock and a hard place. They've got to get inflation down, and they're using if you're a tool, if you got a hammer, everything looks like a nail, and their best tool right now is higher interest rates. The problem for the largest borrower in the world, that is the United States government, that has, the average interest cost on the U.S. government debt is 2% on that $31 trillion. The weighted average maturity of the federal debt is 5 years. So that entire debt is being repriced in a much higher interest rate environment, right? The 10 years now almost at 4%, the 2 at almost 5%. So that average interest rate is going up for the federal government and has been going up. In 2021, the total interest bill for the federal government, net interest bill, was $350 billion. Last year, it was $475 billion. And this year, it'll get to 600 or north of 600 billion. And when you think about it, that $250 billion increase, that's bigger than the size of the Army's budget. Mm-hmm. So the Congress has now got a real problem in front of it, which is interest costs are squeezing out the potential funding of other important programs. And so they've really got to get a handle on, you're not going to solve this deficit problem and debt problem overnight, but we really do have to put the debt of the United States and the deficits of the United States back on a sustainable path.
I think it's safe to say that it's a very unpredictable Congress right now, and that's the very least we can say. And also the fact that many of the people who will be negotiating in this don't maybe particularly want anything in particular. Maybe they just want chaos. So at what point will we see chaos in the markets due to this?
Well, the so-called, we're going to run out of borrowing capacity and cash. Right now, the Treasury is engaged in so-called extraordinary measures in order to extend the life of the payment of all of our obligations on time and in full. But sometime this summer, the ability to do that without an increase in the debt ceiling allowing the government to borrow again is going to become impossible. And the Congress is going to have to decide whether or not they're prepared to, do what is clearly anathema to many members of Congress, which is increase the debt ceiling to allow the government to meet its obligations in the ordinary course.
Put a time frame on it. How many months before we get an actual downgrade, though? Because that's the event that's going to tip markets over, right?
Yeah.
Not the waiting.
Well, listen, in 2011, the last time we went through a Republican House, Democratic president who weren't seeing eye to eye, we got within a day of default. And as a result of that just complete political dysfunction, S&P downgraded the credit rating of the United States from AAA to AA+. Moody's did not join then. If Moody's were to join this year and take the rating down, it would create havoc in the financial markets.
So even barring that issue, you were a former Treasury Department official. The fact that the Treasury is today currently engaged in extraordinary actions to kind of stave off this event for a while, what does that do to Treasury markets? What is the concern here overall between the moves that we're seeing now and the brinksmanship that we might see this summer? Yeah,
right now I think it's not in the market. I think what's in the market is clearly the Fed's interest rate policy. But, if we don't get it together, if the Republican Congress and the president can't figure out a way to raise the debt ceiling, and that may involve a budget deal or it may involve a short extension while they put a budget deal together like they did in 2011, then you're going to see real interest rate volatility in the markets.
You mentioned this calculation earlier about the interest payments rising past the level of defense spending in the United States. What are the complicated equations here? What are the difficult decisions that will have to be made, given that that is the truth? That's the calculation that we're facing here.
The average over the last 40 years of government revenues to government spending it was about a 3% spread. We spent 3% more of GDP than we took in taxes. We're now outside that spread. So Congress and the president have got to bring that back.
But where does it come from?
It's going to come from, you would think, the tools that a Congress has are to raise revenues and lower spending. And it's going to be a lot easier to do both of those in terms of the level of pain. Taxpayers may have to pay a little more, but the beneficiaries of the various government programs that are going to have to be scaled back to balance the pain between recipients of federal benefits and taxpayers.
If we take it back to corporate America and interest rates again, Jim, just to round things off, where are you concerned most about the vulnerabilities, particularly when we started to become a little bit concerned about China and inflation coming out of China post-pandemic too?
Listen, I think if you look at the corporate bond market, you've got about $10 trillion outstanding, of which a very small amount is actually coming due in 23 and 24. The wall of maturities is further pushed out. So really the issue is for companies who, who weren't generating cash flow from operations sufficient to cover their fixed debt costs before the pandemic. And they got a break from this extraordinary stimulus from the Congress and the extraordinarily low rates and liquidity from the Fed. But that's where the rubber's going to meet the road. You're going to have higher financing costs. The maturities are, there's still a couple $100 billion in maturities.
If the corporations are not the problem here, you look at the Biden administration talking about credit card debt, you see them tackling student loans. Is the issue pushed out to the consumer? And is it unlike what you saw in 2008 with mortgages? Are the bubbles elsewhere?
Listen, I think right now, we've got a very healthy job market, and wage growth has been strong. It's one of the problems the Fed is trying to wrestle with, so as to keep inflation from becoming embedded in the cost structure of corporate America.
The mortgages are like double.
But that's so the first hit is on the housing sector is a year's worth of declines in sales of single-family homes, and why? Because mortgage rates are so high. People, the ordinary Americans are facing much higher costs, mortgage costs, and the same will be true for other, durable items.
But Jim, you remember a
financing.
normal interest rate environment, right? I mean, are we there yet, or when do we get restrictive?
I think the mortgage on my first apartment was 9%, so it still looks like 6%. Still looks
Still
like
a
a good
bargain to
deal.
you.
Yeah.